I'm Dave Wagner, and this is the Tidecrest Market Update for March 11th, 2025. Over the past 2 days, the U.S. stock market has seen a significant spike in volatility and a meaningful move downward in equity valuations, primarily driven by mounting uncertainty surrounding U.S. trade policy. The volatility began yesterday when the Nasdaq suffered its worst single-day loss in over 2 years, plunging 4%, while the Dow Jones Industrial Average lost nearly 900 points. The S&P 500 also took a hit, closing the day near correction territory, typically defined as about a 10% drop from its recent peak. Adding fuel to the fire, Citigroup downgraded its outlook on U.S. stocks, lowering its rating from overweight to neutral. The bank cited a pause in U.S. exceptionalism, meaning that after a period of economic outperformance, the country's ability to outgrow and outmaneuver global competitors may be fading. This sentiment has been reflected over the past few months as developed international equity indices have meaningfully outperformed U.S. equities over that span. By Tuesday, markets were still reeling when the U.S. administration announced that tariffs on Canadian steel and aluminum would double to 50% from 25% effective Wednesday. The move was described as retaliation against Ontario Premier Doug Ford, who had independently introduced a 25% surcharge on electricity exports to the U.S. However, by the afternoon, Ford walked back his electricity surcharge, and shortly after it was announced that the 50% tariff hike would not happen at all. Instead, the previously announced 25% duty on Canadian steel and aluminum would proceed as planned. For businesses and financial markets, this kind of uncertainty makes planning difficult, increases volatility, and erodes confidence in the broader economic outlook. Investors are now anxiously awaiting Wednesday's CPI report, which will provide the latest snapshot of inflation trends. A higher than expected inflation reading could make it less likely the Federal Reserve will cut interest rates later this year. The Fed does still have dry powder to cut rates and stimulate the economy if needed, but we're only going to see that if inflation remains in check. If price pressures remain too high, the Fed could be forced to hold off on rate cuts, leaving markets vulnerable to further downside risks. The past 2 days have illustrated just how uneasy Wall Street has become about the economic path ahead. For now, the question remains, is this just a temporary market correction or the start of something more serious? The answer may depend on the Fed, inflation data, and whether the administration brings more clarity to its economic policies in the weeks ahead. As always, we recommend that during times of financial market stress, investors revisit their financial plans, verify accuracy of portfolio time horizons, and confirm that your risk tolerance is appropriately calibrated. Don't forget to subscribe to the Tidecrest YouTube channel, connect with us via LinkedIn, and follow us on Instagram to ensure you receive our latest commentary and thoughts on a variety of financial topics. To learn more about Tidecrest Wealth Management, please visit our website via the link in the description below. As always, thank you for tuning in, and we'll see you next time.